Hi guys, welcome back to the channel. I have already talked about ETF, and in this video, I want to provide a practical simulation of an investment portfolio exclusively in ETF. I said to myself, why not make a video on what to do with the liquidity we have in our bank accounts? The idea is to get you to see how important it is to invest your savings. It's not difficult, but it's not easy either because it requires at least a little effort from you in order to acquire information, plan the next steps, how much capital to invest, time horizon, and the type of risk you are willing to accept. It is important that you have to manage your money, put it into your own hands, especially at a time like this in which there is generally high inflation everywhere, which erodes savings. Now we will simulate a portfolio that can generate an average passive income dividend of around 6.4%. This is real ETF data, but I omitted the tickers just because I want you to learn the logic instead of copying and pasting. You can assume a capital of $50,000, $100,000 or more. The simulation I run is for $100,000, so a portfolio that generates about $530 a month. You'll say that's not much. Well, for $200,000, it's about $1,070 a month. Consider that you are generating passive income from your money that was sleeping in the bank. Instead, by investing it, you get dividends if you invest in stocks ETF or coupons if you invest in bond ETF. You don't have to be a finance guru, but you must have a minimum of expertise to create a structured portfolio, evaluate the pros and cons, be aware of diversification, and above all, monitor the portfolio on a regular basis. One important dynamic you need to know is that the dividend paid is the ratio of the dividend to the price of the ETF. For example, when a stock ETF that is worth 100 comes to detach a 5% dividend the next day, this ETF will be worth 95. If, on the other hand, the price of the 100 ETF falls to 90, assuming the market is down, 5% out of 90 is clearly more than 5%. Therefore, the impact of the dividend on the price in the event of a fall in the price of the ETF is greater. This is why, especially in periods when prices are low and when prices fall, it is interesting to build portfolios, a scenario in which there is also a return of yields on the bond side. Importantly, consider the tax efficiency of dividends or coupons in the case of distributing portfolios. Without going into extreme detail, the coupon is nothing more than an automatic partial sale, but this partial sale has a tax advantage. Because you pay investment taxes on the coupon, you pay taxes basically on the gains you make on the coupons. Instead, you pay taxation regardless to get it right, even if the ETF goes from a price of 100 to 90 and detaches you from the 5% coupon. On this 5%, you will pay taxes, which does not happen in accumulation, because if from 100 it goes to 90, you sell 5, you get 5, and you don't pay taxes. Plus, if you find an ETF that has a high coupon of 10%, that doesn't mean it will yield more. It is simply decumulating. If you get 10% off, the price of the ETF will go down even more. It's always the coupon to price ratio that is important. So don't confuse coupon or dividend with yield. They are two different things because we must also consider the price change in the yield. Now I have specifically divided the portfolio into two parts, 61% and 39%, or following the logic of 60 to 40. I have therefore invested 61% of my capital in stock ETF, which even if they now have lower prices, seem to be maintaining an interesting dividend. 39% of the remaining capital is in bond ETF, which, as mentioned before, are very attractive. The bond market has experienced the biggest crisis in recent times. On the other hand, yields have increased and therefore the coupons have increased, resulting in an increase in the coupons and a decrease in the price. Let's start by looking at the portion of the portfolio with stock ETF. It has a cash flow of approximately $4,500 per year and a weight of 61% equity of $100,000, which is the total amount in the portfolio. For a capital of $200,000, it's about $9,000 a year ever on a gross base. Diversification was split proportionally over 10 to 12% between global, Asian, European, and emerging market stock ETF. The dividend flow, you see, is in absolute dollar terms. We give the same look to the bond portion of ETF. Diversification was mostly done in high-yield bond ETF and global bond ETF. The flow it generates for the 39% of the portfolio capital of $100,000 is about $1,900 or a little less. Dividends vary from 4% to 6%. With this simulation, you can observe the balance and equilibrium of the portfolio. That said, a lot depends on your goals as an investor and the dynamics you rely on. If you accept a higher level of risk, you can increase your exposure to stock ETF or vice versa if you are more risk-averse. Remember that you can always update your portfolio and you must actively monitor it because dynamics or dividends or prices may change over time. A passive income of 6.4% on average per year is not bad at all, even considering that we are always simulating gross amounts. I hope this simulation has been helpful to you. In the next videos focused on ETF, I will also provide name and tickers, but as mentioned, the idea is to share opinions and not copy and paste operations. While you've reached the end of the video, if you are interested in learning more about similar topics, here you will find other really interesting videos from the channel. Thanks for watching this video. Click on the like button if you enjoyed it, and do not forget to subscribe in case you didn't. See you on the next one.